There's a building on the edge of every city that makes more money per square foot than most downtown office towers. No sign, no storefront, no customers walking in. Just steel racks, forklifts, and a loading dock nobody glamorizes. You've probably imagined owning one. Racks stacked to the ceiling, trucks backed into every bay, a steady stream of pallets moving in and out while rent checks land in your account every single month. Money for nothing. A tenant signs a 15-year lease and you just collect. Here's the problem. Almost none of that is how this business actually works. That image is the illusion, and it's the reason so many people buy their first warehouse thinking it's the easiest asset class in real estate, then find out the hard way that it isn't. Start with the scale because the numbers are staggering before you even get to the part that matters. The U.S. industrial and warehouse market is well over 200 billion square feet when you count distribution, fulfillment, and light manufacturing space together. Vacancy has swung wildly, from under 4% during the pandemic boom to north of 7% as e-commerce growth cooled. Annual investment in new industrial construction has run into the tens of billions of dollars year after year. Sounds like a gold rush. Then you look at net operating margins on the actual operating businesses running inside these buildings, not the real estate underneath them, and you're staring at somewhere between 3 and 8%. Not 30. Not 15, 3 to 8. And that's before you separate two things people constantly confuse, the real estate return and the operating return. The land and the building can appreciate 5, 6, 7% a year in a hot market. The actual logistics operation running inside it, the trucks, the labor, the throughput, is the part scraping by on single digits. The building looks like an empire. The business running inside it is barely breathing. Here's the trap nobody explains upfront. Warehouse isn't one business. It's at least 4 different businesses wearing the same steel skin. There's the bulk distribution warehouse, massive footprint, often 500,000 square feet or more, low rent per square foot, high volume, thin margin, built for one anchor tenant on a long lease. It's the least glamorous and the most stable if you can land the right tenant. There's the last mile fulfillment center, smaller, closer to population centers, brutal land costs because it has to sit near where people actually live. Margins here live or die on throughput speed, on how many packages move through the building per hour, not on square footage alone. There's cold storage, refrigerated or frozen space. The most capital-intensive of the 4 by a wide margin, but the one with the fattest operating margins, sometimes double the industry average because so few operators can afford the upfront cost to build it. Scarcity is the entire business model. And there's flex industrial space, a hybrid of office, light assembly, and storage, leased to smaller tenants who pay more per square foot but churn out faster, default more often, and cost more to manage on a day-to-day basis. Same category on paper, 4 completely different risk profiles underneath it, and most first-time buyers don't realize which one they're actually stepping into until they're already holding the deed. Now the part that makes people's stomachs drop, the cost to actually get in the door. Raw industrial land alone runs somewhere between $3 and $12 per square foot depending on the metro, and in supply-constrained coastal markets that number can triple. Shell construction, the concrete tilt-up walls, the roof, the basic structure, costs roughly $70 to $120 per square foot. Add racking, dock levelers, and loading equipment, and you're paying another $15 to $30 per square foot on top of that. Fire suppression systems alone, especially the kind required for high-piled combustible storage, can run $6 to $15 per square foot by themselves. If you're building cold storage, multiply your construction cost by 2 to 3 times, because refrigeration systems, insulated panels, and backup power are not optional extras, they are the entire building. Then there are the costs nobody puts in the glossy brochure. Utility infrastructure, bringing 3-phase power, water, and sewer to a raw industrial parcel, can add another $1 to $4 million on undeveloped land, depending on how far the nearest hookup actually is. Permitting and entitlement, especially in states with strict environmental review, can take 12 to 24 months before a single shovel hits dirt, and every one of those months is capital sitting idle, earning nothing. Truck court and trailer parking, the paved area where 18-wheelers actually maneuver and park, needs to be roughly as large as the building footprint itself, and paving that much concrete is not a rounding error on the budget. And that's before material handling equipment, forklifts, conveyor systems, automated sortation if the facility needs it. Most operators lease this equipment rather than buy it outright, but even leased. A mid-size fulfillment center can carry $50,000 to $100,000 a month in equipment financing before a single order ships. Run the math on a modest 200,000 square foot bulk warehouse, and you're looking at somewhere between $18 and $32 million before you've signed a single tenant. That's before permitting delays, before utility hookups that can take a year in some jurisdictions, before the racking system that alone can run into 7 figures. This is not a business you back into with a small business loan and some sweat equity. This is institutional capital from day one. And that changes everything about who actually plays this game. So where does the money actually come from once the building is standing? The obvious answer is rent. A tenant signs a lease, pays per square foot, and you collect. That's what everyone assumes is the whole business. Here's the catch: base rent on bulk industrial space is often the thinnest, most commoditized revenue layer in the entire model. It's quoted in dollars per square foot per year, typically somewhere between $5 and $12 depending on the market, and it's aggressively negotiated because tenants can walk to the warehouse next door that looks almost identical. Rent gets you occupied. It doesn't get you rich. The second layer is what actually protects the margin: triple net lease structures, where the tenant, not you, pays property taxes, insurance, and maintenance on top of base rent. This is the single biggest reason sophisticated investors love industrial real estate over retail or office. Your operating expense exposure drops close to zero. But here's what nobody tells you about triple net. It only protects you if you underwrote the lease correctly in the first place, and a shocking number of small operators get this structure wrong on their very first deal, eating maintenance costs they assumed were passed through. The third layer, and the one most people never even know exists, is annual rent escalation clauses. Most institutional warehouse leases bake in fixed increases of 2 to 4% a year, compounding for the life of a 10 or 15-year term. On paper, that sounds small. Run the math on a 15-year lease at 3% annual escalation, and your rent roll is over 50% higher by the final year than it was on day one, without a single renegotiation. Take a building leased at $8 a square foot. 15 years later, at 3% compounding, that same lease is generating over $12 a square foot on the exact same building, with the exact same tenant who never once had to sit across a negotiating table. This is the quiet mechanism that turns a mediocre warehouse into a wealth-building asset over a decade, and it's completely invisible to anyone just glancing at the current lease rate. The fourth layer, and this is the one that's exploded over the last decade, is value-add services layered on top of pure storage. Cross-docking fees, pick-and-pack fulfillment charges, dedicated racking rental, and in the case of cold storage, blast freezing surcharges that can run several times the base storage rate. A single pallet of frozen goods might cost 30 to 50 cents a day just to sit on a shelf. But the moment a facility touches it, sorting, repackaging, labeling, that fee multiplies. This is where the real operators separate themselves from the landlords who just collect a check. The building is the platform. The services are where the money actually lives. There's a fifth layer most people never think to ask about: tenant improvement allowances, or TIE, used as a negotiating weapon rather than a cost. When a tenant needs specialized racking, extra dock doors, or reinforced flooring for heavy equipment, the landlord often fronts that construction cost, then rolls it straight back into the base rent over the lease term, effectively charging the tenant interest on their own build-out without ever calling it a loan. Done right. This locks a tenant into a building they've now paid to customize, which makes walking away at renewal time far more expensive than just accepting the next rent increase. Now here's the insider trick almost nobody outside commercial real estate has heard of: the sale-leaseback. A company that owns its own warehouse, say a regional grocery distributor, sells the building to an investor for cash, then immediately signs a long-term lease to keep operating out of the exact same building. The company frees up tens of millions in trapped capital to reinvest in its actual business. The investor gets an instant, occupied, cash-flowing asset with a tenant who has every incentive to never leave. Because moving an entire distribution operation costs a fortune. This single mechanism is responsible for a huge share of institutional industrial acquisitions over the last 15 years, and it's almost invisible to the public because it never shows up as a warehouse for sale listing. It happens in boardrooms, not on marketplaces. The math behind it is what makes it work for both sides. The investor is essentially buying a bond disguised as a building, priced off a capitalization rate, the annual rent divided by the purchase price, that in strong industrial markets has compressed down into the 4 to 6% range. That sounds unremarkable until you remember the tenant is covering taxes, insurance, and maintenance on top of that rent. The investor's actual cash return, after almost zero operating responsibility, ends up looking a lot better than the headline number suggests. This is the real reason so much institutional money quietly prefers occupied industrial buildings with weak tenants over vacant ones with strong upside. Certainty prices better than potential every time. Then there's the bleed, the part that erodes the fantasy day by day, long after the ribbon cutting is over. Property insurance on industrial buildings, especially anything storing combustible materials, has climbed sharply in the last 5 years. In some high-risk regions, it's more than doubled. Maintenance on dock equipment, HVAC, and roofing runs into 6 figures annually on a large facility. And roofs on flat industrial buildings fail faster than almost any other commercial roof type. If you finance the acquisition, and almost everyone does, debt service is often the single largest line item you'll ever face. And a rate environment shift of even 1 or 2 points can turn a profitable deal into a break-even one overnight. Utilities on cold storage facilities are a category of their own. Refrigeration alone can eat 15 to 25% of total operating costs on a frozen facility, running 24 hours a day every day, whether the building is full or half empty. Property taxes reassess upward the moment a building sells for higher price than its previous valuation, which means your very first year as the new owner often comes with a tax bill nobody warned you about. If you're operating the facility rather than just leasing the shell, labor is its own bleeding wound. Warehouse and forklift labor markets have tightened for years, and turnover in entry-level distribution roles regularly runs above 40% annually. Every departure costs money to rehire and retrain, whether or not it shows up as a clean line item. Security systems, monitored access, and camera infrastructure aren't optional in a building holding millions of dollars of someone else's inventory. Compliance costs, fire code recertification. Environmental permitting renewals, OSHA-driven safety upgrades arrive on their own schedule, not yours, and they don't ask whether you had a good quarter. None of this shows up in the glossy pitch deck. All of it shows up on the P&L. And underneath all of that sits the structural risk, the one domino that can take the whole thing down. Warehouses are single-tenant risk machines. Unlike an apartment building with 200 separate leases, a bulk distribution warehouse often has one tenant, sometimes two on one lease. If that tenant's business fails, relocates, or simply decides to consolidate into a newer facility down the road, you don't lose 10% of your income. You lose all of it instantly. On a building custom-built around one company's specific racking height and dock configuration, features that make it harder, not easier, to release to someone else. This is why industrial real estate underwriting obsesses over tenant credit quality more than almost any other asset class. Lenders will price a loan differently for the exact same building depending purely on whether the tenant carries an investment-grade credit rating or not, sometimes by a full percentage point or more on the interest rate. That's not caution for the sake of caution. That's the market pricing in exactly how thin the line is between fully leased and empty overnight. There's a newer version of this same risk creeping in now: automation. As robotics and AI-driven sortation shrink the amount of floor space needed to move the same volume of goods, some tenants are quietly renegotiating for smaller footprints at renewal instead of bigger ones, the opposite of the growth assumption most warehouse underwriting was built on for the last 2 decades. The building isn't the risk. The tenant is the entire business model, wearing a building as a disguise. You don't have to imagine this collapsing. It already has, in full public view. In the early 2020s, e-commerce demand convinced the largest logistics operators in the country that warehouse footprint could only go up. Amazon alone had roughly doubled its fulfillment and logistics footprint in about 2 years, racing to meet pandemic-era delivery demand. Then demand normalized hard. By 2022, Amazon was publicly walking back its own expansion, canceling or delaying tens of millions of square feet of planned warehouse space, subleasing existing facilities it no longer needed, and taking hundreds of millions of dollars in charges tied directly to real estate it had overbuilt. This wasn't a scrappy operator who guessed wrong. This was the single largest logistics network on Earth, with more data on delivery demand than any company in history, and it still overshot its own warehouse needs badly enough to reverse course in public. The subleases alone put tens of millions of square feet of prime industrial space back onto a market that had priced itself for permanent scarcity. And landlords who had underwritten their acquisitions assuming that demand curve would only bend upward were suddenly staring at rent assumptions that no longer held. If the biggest player in the game can misjudge warehouse demand at that scale, with more delivery data than any company in history, the assumption that e-commerce always needs more space was never as safe as it looked from the outside. So how do the operators who actually win at this play it differently? They don't chase single buildings. They build or acquire portfolios of dozens to hundreds of facilities, spreading tenant risk across geographies and industries so no single lease default can sink the whole operation. The largest players in this space are publicly traded industrial REIT, and they don't think like landlords collecting rent. They think like infrastructure owners positioning themselves at the exact choke points where goods have to move. They buy land years before a market gets hot, sit on it as a long-term option, and develop only when demand is proven, not projected. And a meaningful number of wealthy operators aren't even chasing the operating income at all. They're using industrial real estate as a depreciation shelter, offsetting income from entirely different businesses while treating the property appreciation itself as the real long-term payoff. For them, a warehouse sitting at 70% occupancy isn't a failure. It's a tax position with upside attached. They also don't guess at location the way a first-time buyer does. Institutional developers run detailed freight and population density modeling before they buy an acre, mapping drive time radii to highways, ports, and rail intermodal yards down to the minute, because a facility 10 minutes closer to an interstate on-ramp can command materially higher rent for the exact same square footage. A small buyer picks a parcel because it's available and affordable. A large one picks a parcel because a spreadsheet told them it sits inside the exact freight corridor tenants are already fighting over. Now put real numbers next to a good year and a bad year, because this is where the volatility actually lies, not in a spreadsheet assumption. In a strong year, full occupancy, an escalation clause kicking in ancillary fulfillment fees stacking on top of base rent, a 200,000 square foot facility might net somewhere between $1.5 and $2.5 million after debt service and operating costs. That's a real healthy return on a project that cost 20+ million to build. Now the bad year. Your anchor tenant gives notice. The building sits partially vacant for 8 to 14 months while you release it. Insurance renews at a 40% higher premium, and debt service doesn't pause just because your income did. That same building can swing to break even or into the red in a single 12-month stretch. Same asset, same location. A different tenant decision away from a completely different outcome. Cold storage swings even harder in both directions. A fully leased frozen facility in a strong year can post margins north of 20% because so few competitors can match the capacity. But let one compressor system fail during a heat wave, let one insurance renewal spike after a regional claims year, and that same facility can post a loss even at near full occupancy, because the fixed cost of running refrigeration 24 hours a day doesn't care whether the balance sheet had a good quarter. So is it actually worth it? It depends entirely on which version of this business you're walking into. And by now you already know the variables that decide it. If you're buying a stabilized multi-tenant portfolio with strong lease escalations, and you have the capital base to survive a vacancy cycle without panicking, this is one of the more durable real estate plays available, quietly compounding through fixed cost pass-throughs most investors never think about. If you're a smaller operator betting everything on one building and one tenant, you're not really in the warehouse business. You're in the business of praying that one company never changes its mind, and that is not an investment thesis, that's a hope. This asset rewards patience and portfolio thinking, and it quietly punishes anyone who mistakes a single steel box for a diversified income stream. The people who get burned aren't the ones who underestimated the rent. They're the ones who fell in love with the illusion at the very start, the racks, the trucks, the passive check, and never once ran the number on what happens the day that one tenant stops needing that building. The warehouse was never really the product. It was a bet on someone else's business never leaving.